Welcome to the Eggs Invest podcast series, where we explore smart, practical strategies for successful residential property investment across the UK. I'm Anna, your host here at Eggs Invest, and today, we're diving into something that's absolutely critical to your success as a property investor: how to find the right investment opportunities and make confident, informed decisions. Because it's not just about buying property, it's about buying smart. Let's start with the first question every investor asks themselves: where should I invest? Now, we all know the UK property market is vast and varied. What works in Manchester might not work in Bournemouth. So, the first step is learning how to conduct proper market research. You want to look beyond the headlines and dig into the local dynamics. Things like population growth, infrastructure projects, rental demand, and employment opportunities in the area. Use platforms like Rightmove, Zoopla, and the UK Land Registry to track pricing trends, days on market, and even previous sale histories. These aren't just stats, they are clues. Clues that help you understand what's happening on the ground. And don't overlook auctions. Property auctions in the UK can be a goldmine if you do your homework. Sometimes, undervalued gems show up that, with the right investment and management, could deliver excellent returns. But go in with your eyes wide open. Read the legal pack. Visit the property if you can. Speak with the auctioneer. It's not for everyone, but when done right, it's a strategic way to enter the market at a lower cost. Once you've narrowed down a few locations or properties, it's time to get into the numbers. This is where rental income and capital appreciation come into play. Let's break that down. Rental income is your month-to-month cash flow. Capital appreciation is the increase in the property's value over time. Ideally, you want both: a property that brings in consistent rental income now and has the potential to grow in value later. But how do you evaluate that? Start by looking at local rental rates. Use tools like SpareRoom or home.co.uk to get real figures for similar properties. Then, factor in costs, mortgage payments, maintenance, insurance, management fees if applicable. What's left is your net rental income. For capital growth, look at historical price trends in the area, regeneration projects, and future development plans. Areas undergoing infrastructure improvements, like new train lines or town centre redevelopments, often see rising property values. And when it comes to property valuation, don't just go by asking price. Use comparative market analysis. What are similar properties in the area actually selling for? You can also look into gross yield and net yield to compare properties more objectively. Let's zoom out for a moment. To truly understand the potential of a location, you've got to look at demand and supply dynamics. For example, cities with strong student populations, like Leeds or Nottingham, often have a steady rental demand. On the flip side, if new housing developments are being built faster than people are moving in, it can saturate the market and bring prices down. Other factors influencing demand include local employment opportunities, proximity to good schools or universities, transport links to major cities, lifestyle amenities, think parks, restaurants, and shops. Supply is shaped by planning permissions, new builds, and even local council policies. If an area has restrictive planning laws, that might limit supply, which can be good for investors because it keeps demand high. Keeping an eye on UK-wide trends also helps. For example, the rise of remote work has changed what people look for: more space, outdoor areas, or proximity to smaller commuter towns. These shifts affect property prices and rental demand in unexpected ways. All right, so we've covered a lot. How to research locations using real data. What to look for in properties that balance income and growth. How to leverage auctions and spot undervalued assets. and how to understand the broader market forces that influence success. But here's the real takeaway: don't rush. Residential property investment in the UK can be incredibly rewarding, but only when you've done your homework. Every successful investor you've ever heard of started with the same thing: research, patience, and a willingness to learn from both the market and their mistakes. Start small if you need to. Build confidence. Get to know the market intimately and trust that your knowledge is your greatest asset. That's it for today's episode of the Eggs Invest podcast. I hope this gave you a clear and practical framework for evaluating the right investment opportunities in the UK residential market. If you found this episode helpful, make sure to subscribe and share it with a fellow property enthusiast. And of course, we've got plenty more in store, from strategy breakdowns to interviews with real investors doing it right. I'm Anna, and I'll catch you in the next one.